This short video is on calculating GDP. And there are two main ways to calculate GDP. Remember, GDP talks about how much we produce in a given year within a country. There's two ways to calculate. The first way, probably the way that we're most familiar with, I know my wife is most familiar with this, usually with my money. It's the expenditure method. The second method is the income method. Now remember that income and expenditure have to be equal because what you make is what you then spend. And what you spend is what you make. So no matter if we calculate GDP by the expenditure or the income, it's always going to be the same. So let's first talk about the expenditure method. All right, we're talking about spending, the expenditure method. So we're looking at what four groups spend in the economy. So number one, we have consumption. Say you go out and you buy a car. That's an example of consumption. So we take everything that is bought by a consumer. Second group is what we call investing. Okay? And investing is not an individual going out buying a stock or buy a bond or a CD. Investing is what businesses do. So this is what businesses buy. For example, they go out and they buy a crane. A crane is an example of a capital good. And remember, a capital good is a good that is used to build another good. That's the type of goods that businesses buy. Third is government. An example of government spending may be government goes out and they buy a tank. That's government spending. Fourth and last one is what we call net exports. This is exports minus imports. And say, for example, a foreigner comes to America because he hears we have great apple pie. So when we calculate GDP through the expenditure method, we take everything that the consumer buys, everything that the investor buys, which is business, everything that government buys, and that everything that we buy from other countries, minus everything everybody buys from us. When you add that together, you get GDP through the capital, or GDP through the expenditure method. For a moment, let's look at income. Income. Remember, there are 5 different ways legally you can get income. So we've got wages, we got plus rent, plus interest, plus profit. Now, when we talk about profit here, we are talking about individual profit, and we are talking about corporate profit. All right, so let's talk about these 5 here. Number one, wages. You know, you work a job, you get wages. Not only do you get money, but you also get compensation for health care, whatever else. So that all is included in wages. Rent, say I own an apartment or I own a warehouse, and I rent that out to a company or a person. That's my income. And I'm providing a service. Remember, GDP is not just the production of goods, but it's also the production of a service. Interest, if I lend money to someone or give it to the bank, they can pay me interest. In terms of profit, there are individual profit and corporate profit. Those are the 5 ways in which we can get our income legally. Now, in order to get income to equal GDP, we need to do 3 adjustments, and I want to review these adjustments just so we're all familiar with them for the test tomorrow. Right? Number 1, indirect business tax. This is the Wawa example. I go into Wawa, I buy a pack of cigarettes because I've given up caffeine, and I pay $5 for those cigarettes. 4 of those $5 goes to income. The other dollar goes to the government. So if we don't put the taxes back in, our expenditure is 5 and our income is 4. So we have to add the indirect business tax. The second adjustment we have to add is what we call the net foreign tax. The net foreign factor. There are people in America that are making income that are not national citizens, so they wouldn't be in income. We have to add them, and we have to subtract people, Americans who are in other countries, making an income. So that would be the net foreign factor. The third factor, the third adjustment we have to make is what we call depreciation or capital consumption. And what that means is capital consumption is what we've given up to make these goods. So for example, say we made $1,000 worth of goods, but we lost $100 of our machinery. In theory, we only then made $900 worth of goods. But in order to get to GDP, because you remember in GDP, we're talking about gross investment, and gross investment does not take into consideration, doesn't care about depreciation. All right, on this slide, we are going to be breaking down numbers from GDP all the way to DI. So let me just quickly go over this. We have gross domestic product. We know what that is. That's all the products that are produced within a given year. We have net domestic product. Remember, the difference between net domestic product and gross domestic product is really just depreciation. We then have national income, which is basically how much money we produce in America, both individual and corporate, in the production process. We then have PI, which is personal income. And the difference between NI and PI is NI includes corporation, and it's everything made in the process of production, where PI is personal income. And then from personal income, we break it down to disposable income. Let's start at GDP at the top. If you're figuring out GDP through the expenditure method, then you probably want to start at the top. C plus I plus G plus X. If you're trying to figure out GDP through the income approach, my recommendation would be starting with national income. So what you do is you take the wages plus the rent plus interest plus profit. And remember, there's two different types of profit. There's individual profit and there's corporate profit. Once you get the NI, then all you have to do is add the three adjustments. So to go from NI to NDP, what you're going to do is you're going to add the indirect business tax. You are going to add the net foreign factor. Remember, we are going up, so we want to add. You want to add the net foreign factor. And that gives us NDP. Now remember, the difference between NDP and GDP is depreciation. So to get from NDP to GDP, we add depreciation, or what we call capital consumption. The difference between GDP and NDP is the idea that GDP, we're just looking at total production. In NDP, we're saying, okay, we made this amount, but in the process, we lost, or our machinery depreciated in value. So therefore, we need to subtract that out. If you're going down, if you're going up, you need to add that. So that's how we get to NI to GDP. You take the three adjustments, two of which get you to NDP, and then the third will get you to GDP. Now, remember, the difference between NI and PI. Number one, we're going down, so we need to subtract out corporate profit. Corporate profit is not included because PI is personal income. Now, we need to add what we call transfer payments. Remember, transfer payments are payments by the government given to people for doing nothing. Transfer payments like Social Security, welfare, unemployment. Could be money to the vets that served in past wars. All that would be an example of transfer payments. And remember, transfer payments is not part of GDP because we're not producing anything. If you're getting Social Security, you're not producing anything. You're getting paid because you're 65 or you were a vet or you're unemployed. The last thing we got to take in consideration is Social Security tax. All right, so we're going to minus out Social Security tax. This is part of that saying that what you earn versus what you receive. You are earning that Social Security, but you don't receive that until you're 65. So to go from NI to PI, you take out corporate profit because corporations is not part of PI. Transfer payments gets added in because they're not part of GDP, and we subtract out Social Security tax because you're not going to get that yet. That then gives us PI, which is personal income. To get from personal income to disposable income, you have to realize what disposable income is. Disposable income is the income you have to spend. So the difference between PI, personal income, and disposable income is taxes. So we subtract out taxes, and that gives us what we call disposable income. Remember, disposable income you can do two things with. You can either consume or you can save. And that's how you go from GDP all the way down to disposable income.